Welcome back to Successful Living. As we know, the markets for real estate have been booming. Refinances over the last couple of years seem like they're going crazy. And to join us today to talk about that and what's going on in the current market is Steve Tetzner from Homestar Mortgage. Steve, how are you?
Doing great.
It's good to see you. Can you tell us a little bit about kind of the current state of the environment?
Sure. So mortgage rates are off their peak lows. They're about 0.5% higher now than where the peak lows we saw early this year, towards the end of last year. The 30-year mortgage right now is still hovering just below 3%. It's in the 2.75 to 2.875 range. 20-year mortgages are about 0.25% better than that. The 15-year mortgages are holding pretty good. They're only about 0.25% off their peak lows. So we're still seeing 15-year money close to 2% with no points. So rates are still very good. The housing market's still booming and people still out there, multiple offers on properties and bidding over the list price. So it's still very competitive out there.
So you're seeing a lot more purchases than refis at this point?
Yeah, most of the people who have refinanced already, or have refinanced already, we're still seeing a few people that kind of missed the boat. It still makes sense for them. Or we see people that are refinancing maybe to access some of the equity in their home, maybe to do a home improvement project like a new kitchen or an addition and stuff like that. But for the most part, the refinances have quieted down quite a bit.
All right, so you won't see them, will they go take a refinance over a home equity line usually, or?
It depends on the project and what the rate is. If it's somebody, I'll recommend somebody, if they need 30, 40,000 and they're going to pay it back in a couple of years and they've got a really good rate on their mortgage now, then do a home equity. But, if their rate's not that great and they can move lateral or get a better rate and it's going to take them longer, then it might be better to do the refinance and lock into a longer term fixed rate rather than a variable equity line.
Okay. All right, so one of the reasons that obviously I want you here today is to talk a little bit about mortgage insurance.
Right.
And I use the word mortgage insurance as a general term instead of private mortgage insurance or PMI.
Yep.
I know when I first bought my house, I was like, what is this thing? And it's automatic, I have to have it. What is it? Tell our viewers kind of what it is and how does it benefit the buyer and the seller? Now, well, the buyer and whoever the insurance is.
Yeah, so it benefits the buyer.
Okay.
And everybody's, it's a big misconception that mortgage insurance is evil and nobody should have mortgage insurance. Well, if mortgage insurance didn't exist, people would have to put 20% down payment in order to buy a house. So it enables people to be able to buy a home with smaller down payments. If you didn't have mortgage insurance, a lot of people wouldn't be able to afford to buy homes because they wouldn't have the 20% required. There are basically two types of mortgage insurance. There's private mortgage insurance, which you mentioned. That's typically written for conventional or jumbo mortgages, and that's through private insurance companies. In other words, usually publicly traded, regular type of what we call private mortgage insurance companies. Then there's also mutual mortgage insurance. Mutual mortgage insurance is insurance that's basically backed by the federal government. So it's pooled insurance and it's applied for government insured loans like FHA, VA, and USDA loans.
Okay.
So there are two different types. Depending on the type that you have, or the type of loan that you're taking, that would determine what the premiums are and how the premiums are affected.
And you have to have that if you're below 20% legally, correct? Regardless of what kind of loan it is?
Yes, you do.
Okay.
Unless you do a creative type mortgage like the old 80-10-10 or 80-15-5, where you take a first mortgage and then simultaneously you take a second mortgage or a subordinate lien. But based on the cost of PMI right now, and when you do that, it negatively impacts your interest rate on your first mortgage. It's really not worth doing it that way anymore. You're better off just taking some type of version of mortgage insurance.
Okay. And they actually do make some money, right? So I know you said it benefits the buyer, but in a sense, those companies that are selling that, they're making the money.
Of course.
And really what it is they're saying if you default, they're going to come in, is that correct?
So what they're doing is the mortgage insurance is sharing the risk of default with the lender. So
Okay.
Fannie Mae and Freddie Mac, own the loan. They're making a loan to somebody that's putting 5% down. That person defaults on their mortgage and they have to foreclose. Fannie Mae is going to experience a loss. The mortgage insurance company will come in and share a percentage of that loss with Fannie Mae to defer the cost to Fannie Mae. So, or Freddie Mac or what have you. Same thing with the government insurance products. If somebody defaults on an FHA loan or a VA loan, they put in a claim to the federal government pays the claim and defers the loss of the lender.
Okay. What is the cost to this? So to the consumer, what does it cost?
So that's kind of a wide open question because on the private mortgage insurance side, The cost of the mortgage insurance is based on the risk of the loan. So we look at a number of factors. We used to have just a standard rate card, and everybody that fit in a box, that was their rate. It doesn't work that way anymore. So now it's all like algorithms that have been set up through risk, through the PMI companies. So we have to input data. So things that affect the cost of the insurance are the amount of the down payment, 5% down, 10% down, 15% down.
So it'll be cheaper the more you put down.
Yep, the more you put down. The higher the FICO score. If there's multiple borrowers on the loan rather than just one borrower.
Okay.
It also even looks at the debt to income ratios. What's the housing debt expense? What's the total debt to income expense?
Okay.
So it looks at all of those factors. So if I just tweak one factor and I run two scenarios, it's going to give me two different costs for the private mortgage insurance.
And can they be drastically different, or it all depends on?
If there's a drastic difference, like if I have somebody that has a 660 FICO score versus somebody that has a 760 FICO, both putting 5% down, you're going to see a significant difference in the cost of the private mortgage insurance.
So it can make a difference of you buying a house.
It's significantly, yeah.
Yeah.
And that's why at some point, when if your FICO scores are really low, sometimes you're better off to transition out of a conventional mortgage and move into a government-insured mortgage. The government-insured mortgages, the PMI of the mortgage insurance is not affected by the FICO score.
Okay.
So they're designed more for the borrower that has the lower FICO, higher debt to income ratio, the higher risk loans, where the PMI could almost price them out of the loan.
Got it.
So
Okay.
the mortgage insurance on the mutual mortgage insurance, the FHA, the VA, they typically have an upfront premium and then they have a monthly premium, with the exception of the VA loan. The big misconception about VA loans is they don't have mortgage insurance. They do have what's called a funding fee, which is an upfront fee.
Just a different name.
It's just a different name. And the only people that are waived or exempt from that in a VA loan is somebody that has a disability or is collecting disability monies from the VA, or if they had earned a Purple Heart in service, then the VA funding fee is waived.
Oh, okay. When I think of PMI, right, let's say you had that person that needed to get to 20%, they put 5% down. Obviously, over time, they're eating away at their, paying off some principal, and they're getting closer to the 20% down. As that's happening, will that rate adjust? Because in a sense, the person who has the insurance, the company, is less on the hook now because there's more being paid towards the principal. Does that work that way or no?
No, it doesn't.
No,
So
right?
on the private mortgage insurance side, the PMI rate does not change. But when the person is at a 20% equity position, the PMI will be eliminated and it will drop off the loan
And that's
completely.
automatic, or you need to remind them,
It will
you need to
happen
look at it?
automatically. There's federal laws in place that protect
Was
the
it always
borrower.
like that or no?
The law's been in place, I think, since at least the 1980s, maybe
Oh, all right.
70s, so
Okay.
it's been around for quite a long time. On the government side, monthly mortgage insurance is life of loan. So,
Really?
yeah, so every year on the anniversary date of the loan, on an FHA loan, for example, the PMI or the monthly mortgage insurance is recalculated based on the new principal, so it does go down a little bit each year,
Yep.
but you pay it for the entire term of the loan. Unless on an FHA loan you put down 10.1%, then when you achieve after 11 years, then you can drop the mortgage insurance on an FHA loan. But otherwise, it's life alone. So that's why a lot of people will try to refinance out of their FHA mortgages and get into a conventional mortgage. And during the refi boom, we saw a lot of that because it was the perfect storm. Interest rates dropped, property values skyrocketed. So people that bought houses 2 years ago, all of a sudden had almost 20% equity in their home.
So then they just refinanced, they got rid of it.
Yep.
Interesting. Now, what if the market, I just thought about this right now, what if the market went the other way, right? So let's say you put 20% down, and for some reason rates were good, and you had to refinance it, but now you actually had less down because the house was worth more in a sense. So like you don't have to, let's say all of a sudden it went from whatever your value was that you had equity in, started at 20,000 and now shrank to only, or 20%, now shrank to 10%. Does that change at that point?
No.
No.
So
it's the original purchase?
Yep, it's based on the original purchase.
I know it was kind of a
price
confusing
house,
question. I was
yeah.
trying to figure that out. But
Yeah, it's based on the original. So in other words, if you purchase a home, you put 10% down, and then the market declines, and that 10% equity no longer exists because the value of your home went away. Based on the original purchase price of the home, when you get to 80% of that original purchase price, the private mortgage insurance will still go away.
Got it. Okay. Are there any misconceptions out there when people think about this mortgage insurance that they should be kind of aware of or uncovered? Is there like major misconceptions to it?
I think one of the major misconceptions is that everybody says, well, I don't want to pay PMI and I'm not going to pay PMI, and they think it's an evil thing. But again, without mortgage insurance, people would not be able to buy a home without 20% down. And first-time home buyers, the majority of those people do not have the 20%. Usually the 20% down buyers are people that are selling a home, they're rolling that equity into the new home. So I think mortgage insurance is a good thing. It opens the market up to a lot of people that would otherwise be excluded.
All right, and then finally, I kind of wanted to end with this a little bit. It seems to me, and I don't really know as much as you do about this, obviously, that we've kind of come out of this refinance, and you kind of mentioned it earlier, that everyone seems like they've refinanced, and maybe there is still something left there where someone might say, I kind of missed that. What's a scenario where, for our viewers, they might say, listen, I was going to refinance, but the rates are kind of going a little higher now. What's a circumstance you might say, hey, you should still consider refinancing?
I think that number one, when we talked about earlier, if you're looking to do a home improvement project or consolidate debt, a cash out refinance where you're accessing some of the equity in your home, that's still something to consider. But the individual situation will dictate the better way to proceed. There are still people out there that kind of missed the boat. I'm refinancing some people that missed the boat. They've got rates in the low to mid threes, and they're actually refinancing down to 15-year notes.
Okay.
So if you can refinance and you can afford a little bit of a bump in your monthly payment, the 15 years is probably one of the best deals out there. You can still get rates down in the low twos, and when you look at a 15-year amortization versus a 20 or a 30, you save a lot of interest, not just because you have a lower rate, but because you've accelerated the loan. You're paying the loan off so much faster that when you take 10 years of interest off a loan, you're talking about a significant amount of money.
Yeah, great advice. Thanks for being here again. I appreciate it.
My pleasure.
When we return, we're going to talk about life insurance, when to use it, and how it works. Stay tuned.